Welcome everyone. This is our second module on the problems of rural credit market. In this particular module, we shall focus on two issues. Number one, we shall try to know why rate of interest is higher in rural informal credit market. Secondly, we shall try to know why there is credit rationing in rural credit market. So let us start our discussion by asking a question. Why there is high rate of interest in the rural informal credit market? The first explanation regarding this is known as lender's risk hypothesis. The lender's risk hypothesis assumes that the lenders earn no ex-ante return on their money over and above their opportunity cost. However, the lenders face substantial risk of default. The borrower might default in paying the interest rate, the principal, or both. There can be two reasons for default: voluntary default or involuntary default. Involuntary default can occur due to sheer misfortunes like crop failure, unemployment, disease, death, etc. According to this hypothesis, it is the probability of default that raises the interest rate in the rural informal credit market. To understand the problem, let us start with an example. Suppose a rural credit market has an exogenous probability of default denoted by 1 minus p. Here P represents the proportion of loan which will be repaid. So 1 minus P is actually the proportion of loan which will not be repaid, and hence this can be considered as an proxy of the probability of default. Now the theory also assumes that competition between the money lenders drives the rural interest rate down to a point where each lender on an average earns zero expected profit over and above the opportunity cost of funds. Now suppose L represents total amount of fund lends out, R the opportunity cost of funds. Now this opportunity cost of funds can be the formal interest rate. Suppose I represents the interest rate charged in the competitive equilibrium in the informal sector. So, under these assumptions, the expected profit of the money lender will be P times 1 plus I into L minus 1 plus R times L. The zero profit condition assumes that at equilibrium this expected profit will be zero. So making the expected profit equal to 0, we get the value of I as 1 plus R divided by P minus 1. Now we can think of two possibilities. Possibility 1 is when P equal to 1. That means there is no default risk. In case of no default risk, if we put P equal to 1, we get I equal to R. That is, the informal interest rate is equal to the formal interest rate. On the other hand, if we consider P to be less than 1, that is, there is a possibility of default, then we will have I greater than R. that is, the informal interest rate is greater than the formal interest rate. So here, informal interest rate becomes greater than the formal interest rate due to the possibility of default on part of the borrowers. So, what the lender's risk hypothesis actually tries to say is that the risk of default is actually an indicator which shows why the informal interest rate is greater than the formal interest rate. However, there is a problem. Alim in 1993 showed that the actual default rate in the rural credit market is below 5%. Now, this in turn indicates that the probability of default in rural credit markets is actually quite low. So, though the lender's risk hypothesis is a good theoretical explanation, in terms of its empirical validity, it is almost inapplicable. If that is so, then what can be the alternative explanation? The alternative explanation comes from a hypothesis which is also known as default and collateral. According to this hypothesis, due to the fear of default, all the lenders ask for some amount of collateral. There are various forms of collaterals. For example, land may be mortgaged to the lender. The use right to the output of the land can be in the hand of lenders as long as the loan is outstanding. Secondly, labor can also be mortgaged and can be used later if the loan repayment does not occur. Thirdly, there can be some exotic forms of collateral. For example, in certain parts of Kerala, handing over ration card to the lender has been observed to be taking place. In these situations, the ration cards were considered to be the collateral. In certain areas, borrowers with coconut trees in their land are found to mortgage the right to coconut. Now, given these different forms of collateral, let us assume that L is the amount of loan needed by the small farmer. The small farmer approaches to the landowner who is known to lend money for such purposes. The landowner asks the borrower to pledge the land as collateral for loans. Suppose I represents the interest rate charged on the loan. The land which is set as collateral has different values for both the small farmer and the large farmer or money lender. Let us assume that for the small farmer the value is Vs, while for the large farmer the value is Vb. Let us also assume that the small farmer, in addition to Vs, also places an additional value of loss amounting to F for the land. This F may include the fear of not receiving future loans or even the threat of physical retribution. Given this, if we consider the case of voluntary default, then voluntary default on part of the borrowers can take place only after considering the benefits and costs of such default. See, if the borrower defaults, total loss to the borrower will be Vs plus F. On the other hand, the total gain in this case will be L into 1 plus I. So the borrower will prefer to return the loan if L into 1 plus I is less than Vs plus F. On the other hand, the lender will prefer her money back if L into 1 plus I is greater than Vb. So after a few adjustments, we find that loan repayment is of interest for both the parties if Vb is less than Vs plus F. However, for our analysis, we shall consider the reverse situation. That is the situation where Vb is greater than Vs plus F. In this case, whenever the borrower prefers to repay the loan, the lender will actually want her not to do so. In fact, the lender will actually initiate the credit transaction with the objective to acquire the land of the small farmer. The only way in which the lender can do so is to drive up the rate of interest. In this case, even if the borrower does not default voluntarily, circumstances will lead to involuntary default so as to ensure that the land is transferred to the lenders. So, what we get from this discussion is that it is not the willingness of the borrowers to voluntarily default, but the incentive on the part of the lenders to grab the land market makes the informal interest rate quite high compared to the formal interest rate. Now let us move to our second issue. Let us start with the question: what causes credit rationing in the rural market? To understand the issue, at first let us give a proper definition of what do we mean by credit rationing. Broadly speaking, credit rationing refers to a situation in which at the going rate of interest in the credit transaction, the borrower would like to borrow more money, but it is not permitted by the lender. Now, why such credit rationing arises? There are two explanations. The first explanation assumes that the moneylender wishes to allocate her available funds in such a way that maximizes the return on the funds. At the same time, it is also assumed that there exists a large number of potential farmers in need for working capital for production. Suppose the production function is given as y is a function of L, where L represents the amount of loan undertaken. Suppose the rate of interest is I. So the profit will be FL minus 1 plus I into L. This is represented in this particular figure, where the concave curve represents the production function and the line represented by L into 1 plus I represents the cost of production. Let us further assume that the borrowers have certain alternative avenues in which they can earn capital A amount of money. So in this case, the lender have to set the rate of interest I in such a way that at L amount of loan, the profit to the borrower will be exactly equal to L. Now let us assume that this optimal rate of interest is I star. Now let us introduce the possibility of default. Let us consider an n period problem. In the n period problem, if the borrower, that is the farmer, defaults, then the farmer will get the entire amount FL in the current period. But after that, she will be able to earn A for the remaining n-1 periods. So the total earning for the n period will be FL plus n-1 times A. However, if the farmer do not default, then for the entire n period, the farmer will be getting FL minus L into 1 plus I. So the no default condition states that n times FL minus L into 1 plus I should exceed FL plus n minus 1 into A. Now, this can happen if FL minus n into n minus 1 times L into 1 plus I is greater than equal to A. Now, in the context of the picture we have shown earlier, the only change will be that the term L into 1 plus I, which represents the straight line, will now be replaced by n into n minus 1 times L into 1 plus I. That means now the effective cost will become n into n minus 1 times L into 1 plus I, and given the fact that n into n minus 1 is greater than 1, this will be steeper than L into 1 plus I line. So let us define this line as the modified cost line. Now given this, what we get is that when we consider the modified cost line, the optimum amount of loan will be less than L star. Let us define this optimal amount of loan as L double star. So what will happen in this situation is that instead of giving L star amount of loan, which is denoted by the lenders, the borrowers will be actually willing to give L double star amount of loan, and hence there will be credit rationing. Now let us move to our second explanation. The second explanation is related to informational asymmetries. In the rural market, not all the borrowers bear the same amount of risk. There are both high risk borrowers as well as low risk borrowers. However, informational asymmetry prevents the lenders from finding out who is high risk borrower and who is low risk borrower. So, the problem is how to find out who is more risky and who is less risky. One possible way to tackle this problem is to find out the observable characteristics of the household and take decisions on the basis of it. For example, a diligent farmer with significant amount of land can be considered less risky. a landless labor with poor health can be considered to be risky. But what will happen if the difference is not that wide? Then the interest rate will depend on the mix of clients and hence on the average probability of default. Now, this may give rise to a situation in which at the prevailing rates, some people who want to get loan will unable to get it. This will create credit rationing. For example, consider a moneylender who have two types of potential customers, a safe type and a risky type. Let us also assume that each type of borrower needs loan of size capital L. The safe type borrower will always be able to return the loan as her return R will always exceed the amount of loan L. The risky borrower, on the other hand, can obtain a return R prime which is greater than R with probability P and a lower return 0 with probability 1 minus P. Now, had there been a chance to identify the borrowers, the lender could charge different interest rates on different borrowers, so in such a way that their expected return will be equal to 0. In such a case, I1 would be the rate of interest charged on the safe borrowers, while I2 would be the rate of interest charged on the risky borrowers. Clearly here, I2 should be greater than I1. However, what would happen if there is no chance to distinguish between them? One possible policy would be to charge the higher interest rate, I2. Now, had the rate of interest been charged at that level, only risky borrowers will be willing to take loan. On the other hand, if an alternative policy of charging a lower interest rate takes place, then both type of borrowers will apply for loan and the associate profit here will be pi 1. Now, if the associated profit with interest rate I2 is pi 2, then what we find is that if P is less than R by R prime minus 1, that is, the risky borrower's probability of default is sufficiently high, then pi 1 will be greater than pi 2. So, a pooled set of borrowers will get the amount of loan, but here again there will be credit rationing. So, what we learn from this discussion can be summarized in this way. First, what we learned is that rural credit market exhibits the presence of both higher interest rate and credit rationing. Default probability has been considered to be one of the basic reasons for higher interest rate in the rural credit market. However, empirical evidence in this regard is quite weak. It is mainly the incentive on the part of the lenders to grab the land makes the informal interest rate quite high. Preventing the borrowers from default has been one of the major reasons for credit rationing. And lastly, the inability to distinguish between risky and non-risky borrowers also promotes rationing of credit. This is what we have on this module. Thanks for watching.